and welcome to the new FT headquarters. I'm here with Clive McDonnell, Head of Global Equity Strategy at Standard Chartered Private Bank, who's over from Singapore. Thanks for joining me. Now, I know Standard Chartered are quite bullish on equities and that US equities are very much your favoured market. Could you briefly explain why?
Standard Chartered is bullish towards US equities. We have been since the start of the year. The main factor driving our optimism is our view that earnings into 2020 are going to start recovering once again, driven by excellent non-financial corporate margins. Margins in the US at the moment are over 13%, and we don't see any reasons why there should be weakness or margin pressure at the moment. As long as those margins remain resilient, we're going to remain positive on US equities.
Are there particular sectors within US equities that you like?
Yes, within US equities, energy and healthcare are two standout sectors that we're bullish towards. But I think of most interest is a sector that we've recently downgraded, which is technology, a sector that many investors are quite positive towards. Our concern about the outlook for technology relates more specifically to some of the social media companies. We think that there's a high risk that there could be an investigation in the US with regard to the use of personal data by social media companies in the US, similar to what's taking place in Europe. That poses a threat to some of the biggest social media companies out there. They, at the moment, their raw material, personal data, is essentially sourced for free. But that could change going forward, putting pressure on their corporate margins, which would expose their very, very high valuations and put their share price potentially under pressure.
So is this an existential threat to these companies or just something they're going to have to factor in going forward?
No, we don't believe it's an existential threat. It's something that will result in lower margins, potentially lower valuations, and they'll have to adjust to this new environment, new business model.
Now, moving away from the US, yesterday we heard Mario Draghi giving himself some room to announce further stimulus down the line later this year. Will that be enough to kind of buoy up the European economy? How positive are you on Europe?
European equities is an area where we're more cautious towards. Mario Draghi's comments in terms of further cuts in the ECB deposit rate have negative consequences for the largest sector in the euro area, the banks. And that leads us to be quite cautious towards banks and indeed cautious towards the broader euro equity market. However, one thing that we are increasingly focusing on, and a scenario we can see developing, is a hard Brexit by the UK on October 31st, but that being accompanied by a significant fiscal stimulus package of the order of 50 to 70 billion pounds. There is negative consequences for the euro area of a hard Brexit. I think the European Commission would also have to come through with some form of fiscal stimulus, as well as individual countries targeting a fiscal stimulus. If the equity market begins to focus on this, and indeed the bond market as well, that actually could change the dynamic for European equities. But as I say, it's a scenario we have at the moment as opposed to our core or our base case, which is more cautious.
You seem to be saying that almost it may give some sort of a stimulus to Europe Brexit because countries are going to have to respond and will have to put money in.
There's a negative hit to growth. If there is a hard Brexit, there's no doubt that the UK will experience a recession, and indeed it's likely the euro area could tip into a recession as well. The market at the moment is currently discounting a significant slowdown in domestic UK stocks, the FTSE 350, and likewise weakness in euro area growth. That's priced in at the moment. Whereas if we were to see significant stimulus by the European Commission and individual member countries, that could change the dynamic of the market. The market could focus on the outlook for the auto sector and the potential for a revival and growth there. And that actually could lead to a re-rating. What we always highlight is the market is a discounting mechanism. It's looking ahead. It's already anticipated the slowdown underway. The question is, will that get worse? Or actually, could there be some stimulus to offset that? But it's really going to have to come from the fiscal as opposed to the monetary side.
Now, how bullish are private banking clients at the moment? We've had this bull market that seems to have gone on forever. People keep saying that at some point there's going to have to be a slowdown, there's going to have to be a correction. How do you feel your private banking clients are approaching equities in general?
Our private banking clients, they tend to be divided into two areas. One is those that are focused on income generated from alternative sources, such as real estate investment trusts, and also from more traditional sources in the bond market. And there they tend to be more focused on emerging market dollar bonds or emerging market local currency bonds as a way to generate a nice steady source of income. Indeed, year to date, both REITs and emerging market bonds have actually done extraordinarily well and delivered some healthy capital gain. those clients are quite content. Then we also have our growth-orientated clients that tend to invest in private equity or indeed in equities. And we can split those between those that have been invested during the first half of the year and those that have been waiting for the dip. Logically, those that have been waiting for the dip have been disappointed because they've missed out on the 15% growth in global equities in the first half. But very interestingly, for those clients that have benefited from the growth in the first half, their equity market appreciation in the first half, their number one question is, should we sell out of our positions and raise cash? Because after such good performance in the first half, surely that can't be repeated in the second half. But we went back to 1990 and we've established that there were 7 occasions when the first half of the year generated double-digit returns. And in 7 out of those 7 occasions, the second half also featured double-digit returns. So the message we're delivering to our clients is stay invested. A good first half historically has led to a good second half.
Clive, thank you very much for joining me this morning.